Hello there. How are you
Good
guys?
morning.
Good
What's
morning.
up, T?
What's up, guys?
What
Well,
up?
another webinar, your weekly update here. I want to keep you guys in the loop of what I'm looking at and how we're about to tackle this week. We had a whole bunch of economic data last week, and I've been kind of pouring through it. So I kind of want to give you guys ideas on how to navigate this week and what I'm going to specifically be doing as well. Last week was mainly our our confirmation that indeed the bull market is roaring back. We got a pullback as expected, as we were talking about. We were hoping that we would get a pullback so that we can continue running higher. We got that the whole of last week mostly. We were trading flat at some point throughout the week, which was expected. But I think what's important here is to really look at the broader picture of what we are setting up for. And so, what is actually happening in the market backdrop? What are we looking at in terms of economic activity? What do we have to consider going forward in the next few weeks, months, as we come back into a period of normalization, I would say, right? So we have vaccines that are rolling out. Singapore is also aggressively rolling out the vaccine program. I think countries have been building stockpiles and efficiently building networks so that they can kind of roll out these vaccines as efficiently as possible. And I think that has been a little bit of what this past month has been about. Majority of the countries are waiting. They're waiting to see what's going on. So then there was also the little bit of an inflation scare that was the major narrative center focus of last week, the week before, caused off a little bit of a sell-off, yada yada, and now we're back again, right? So was the inflation kind of the run up, and by the way, the rates, the 10-year rate still continues to climb here. Is this such a big problem? Do we see this as becoming a huge issue? Well, to me personally, I don't think so. To me personally, I don't think so. There's a couple of reasons why, and I'm looking at this from the standpoint of yields. I'm looking at this from the standpoint of economic activity, unemployment, and just overall macroeconomics. So we've seen mainly through the pandemic that a lot of demand for bonds were insatiable, right? So what this truly is a correction, if you look at it. This was what happened in 2020 during the pandemic, right? Rates for, the 10-year bond, okay, the 10-year bond got so cheap, in terms of yield, got so cheap that, people were overbuying these bonds. Why? Because, people were afraid of whether we would, get a recovery. Are we going to go into a recession? Is this going to be a global financial crisis? A lot of people ended up buying a ton of bonds at that point of time because, the Fed had promised that they're going to keep rates low, et cetera, et cetera. So a lot of people snapped up these bonds. This is just the 20 plus year treasury bond, but you'll see the similar situation in the 10-year bond as well. So both, we had an inverted yield curve at that point of time. The yield curve wasn't like this, it was like this, right? And so we were seeing a lot of people risk off during the pandemic, right? This was when the S&P 500 made a huge dip, right? During a pandemic. Okay. So what is this? What is actually happening right now? I honestly think this is a good correction for the bond market. This is where we've been trading for a long time down here in the 115, 30 range, and we're back there now. We're back there. Okay. In fact, I think that this is a normalization of the bond prices, but I think that this an over sensationalization of the media and news outlets caused the investors to spook, which gave us all amazing buying opportunities, which we have been covering on the Everyday Growth Advisors Discord, YouTube channel, yada, yada. You guys know it. We've been covering this on the live stream for a long time, right? Like, hey, if the next dip comes, that's your opportunity to buy. The bull market's coming around and, pick up all your equities, right? Which is what majority of us did on this dip right at these two levels here, right? Majority of it, well, I think I picked up my first tranche around here and then the second tranche around here, right? And I got some really good share prices down here. And, right after that, the bull market's almost back to all-time high, right? But what's lagging is the Nasdaq. The Nasdaq is lagging. Well, there's a reason why it's lagging, and there's a reason why it may continue to lag for a little while. But ultimately, the Nasdaq will be back, right? The Nasdaq will be back. So you have to take this opportunity to take up long positions in tech and not buy up the things that are rallying right now, right? Because obviously the things that are rallying right now are your reopening stocks. So what is the market trying to tell us? Well, the market is trying to tell us that, hey, we are projecting that these value stocks, the ones that are cyclical especially, are about to, do extremely well, which makes sense. Why? Number one, there's a lot of pent-up demand from the pandemic, right? If you look at the monthly performance of the S&P 500, you can see that financials have rallied like crazy, and lots of your travel stocks have rallied like crazy, okay? Energy has rallied like crazy, and the majority of your other kinds of entertainment stocks have rallied. So has industrials. What do all of these have in common? Well, they're all pointing towards the market rewarding the reopening stocks. These are all reopening secular trends, okay? Even basic materials, even companies like United Healthcare. These are specific for healthcare because of how the pandemic is going to roll out. These companies stand to benefit. What are the ones that have been hit the hardest? Tech. It's been tech, right? Tesla, Amazon, Walmart, Costco, Target, right? These were all doing good, and now, okay, Johnson & Johnson is a case that is beyond that. Netflix, which I think irrationally sold off. Apple, Microsoft, all of these stocks are trading at a deep discount, right? PayPal is down 12%. So what is happening? Well, the market's trying to tell us that, hey, listen, in 6 to 8 months from now, these stocks are going to be doing great. And so they're pricing in that value right now, right? And in a couple of months from now, the market's no longer going to be buying these up. In fact, the market will start rotating out of these back into tech, right? Back into tech. Because when the economy goes back to full saturation, pent-up demand gets whacked up, everything's doing good, then we'll have tech companies that, once again, will take the crown. And how do I know this? Well, it's simple, basic mathematics. Look at how many tech companies make up, the highest percentage in the S&P 500 by composition and weight, right? And I keep repeating this over and over again, but I feel like I need to. I just need to. You have a huge weight of tech companies, okay? 5, 10, 13, 14, 15, 16, 17, 18, 19, 20. Your top 20 companies are made out of at least 20+% of the S&P 500, okay, in terms of weight. And, it makes sense, right? So if let's say the rest of the market rallies and, when we see that rotation happen, the rally for tech is going to be epic, right? So you have to load up and hold on to your guns so that you can take advantage of that situation. Now, obviously, the tech sell-off has been slightly irrational, right? Because what makes you think that these companies are going to perform poorly just because the market's opening back up? To think that the demand for Amazon is going to slow down by, I don't know. Do you think that the demand for Amazon is going to slow down by 6%? Do you think Amazon's revenues will go down by 6%? No, I don't think so. That's irrational. Do you think Apple will sell 10% less iPhones? No, I don't think so. Do you think, Nvidia will sell less chips, like 12% less chips? No. So, the logic of the market obviously is disconnected from the process, but that's completely fine because that's what the market's meant to do. It's meant to efficiently allocate capital to what we see as a sector rotation in the next 6 to 8 months, right? We don't talk about what the economy is worth now. We talk about what it's worth in the future, and we price that in now. That's how valuations work. That's how market structures work. And that's how we stay ahead of the curve. Okay, so that's the key thing to note today, right? The key thing to note today is, okay, we have all these things that the market is pricing, but what is it actually trying to tell us? It's trying to tell us that there is a broader recovery underway, and we don't see signs of inflation yet. So what are the few key things that we're looking at to summarize? The few key things we're looking at is full employment. We want to approach full employment, okay? Employment is going to be a big one. Why? This drives the economy, right? This creates jobs, this creates cash flow, this creates payrolls, this creates opportunities for more people to be contributing to GDP and contribute to the growth of the economy in general, right? We also want to see inflation controlled, okay? Inflation controlled. Now, we don't see any signs of inflation just yet. And make sure that, obviously the media is going to try and sensationalize things, but we don't see signs of overinflation yet. And I don't think that we will. Reason being, because there are certain possibilities that it happens, but let me explain to you why I think that it won't happen. So let me tell you the reason why it could happen, first of all. So last week I put out a report here, right? And by an article by JP Morgan, right? And JP Morgan actually put out a chart saying, we are seeing improved demand, and manufacturer PMI, which is the Purchase of Manufacturers Index, right, came in at a strong output growth rate, the strongest one since 2018. But the prices paid index also climbed to 86, which was the highest it has been in a decade. So what does that mean? It meant rising inflation pressure as the key materials got highlighted, right? So what actually will happen here? Well, suppliers are delivering on record, but they're paying higher prices for it. And this is something that we spoke about a couple of weeks ago. I was saying, as this pandemic opens up, there's going to be a higher cost to doing business. And this is something that's going to, be a structural change, because businesses have to find new ways to start increasing productivity. And doing so may be different in this environment. Now, this may be a problem in the short run, but I think that the inflation here is overstated. Or at least I don't think that it's going to be a big, huge problem. I think that mostly what happens is that the cost gets spread out between the supplier, the buyer, and then the ultimate consumer. Okay. And so I think if the economic scales and the economic process works out the way that it's supposed to, then majority of what's going to happen is the person who's buying the product is going to pass on the cost to the consumer. Now, if that happens, then we collect higher taxes anyway. So all in all, I don't think that we will see a huge inflation spike from this. Okay, but it could be a slight smidget of a scare. It could be a scare. It could be one of those things that happen for one quarter and then goes away. Because as the new normal starts to kick in, we'll see adjustments take place. Okay, so that's one thing. Also, you'll be receiving this weekly report, a new weekly report today before the market opens. I'm still working on that one because I want to get in all the possible information that I can right before the market opens. So stay tuned for that. And okay, so we spoke about all of the things that matter. I personally think at this point, a rally to all-time high is not out of the question, and we're already pretty much here. Do we just go all the way straight up, or do we have a correction first, or what happens then? Well, those questions are all unanswerable. You cannot predict anything. You don't have a crystal ball to know what's going to happen. But what you do know is eventually the market will end up higher than where we opened up this year. And I have already mentioned that this year I don't think we will get a double digits. More than likely, you're going to see a growth in the S&P 500 or the broader market in the range of about 8 to 15%, somewhere around there. I don't think that we'll get a 20% rip this year. I think it would be a little exuberant to go that high, but Who knows? Who knows, right? We have been surprised before, and we may be continue to be surprised. Okay, other key things to watch this week. So I'm going to summarize at the end with what are the key sectors that I'm watching, and maybe also point out some stocks that I think may be important in the report. But I will point out the sector for you guys, and you can go and look at what you like, and then the report will contain tickers that I like. So I've mentioned and covered about the yield, why the yield rising doesn't matter. I squashed that. I personally think that the yield will continue to rise. In fact, I think we may continue to get up to the 2.0 level yield. And I think that's still nominal. That's where we have been for a while, okay? We are recovering back to where it was instead of going up irrationally, right? We fell. Remember that the 10-year yield this year was at 0.4 to 0.6. And I think the rise back up to the 1.8 to 2 is nominal yield at what we were last year, okay? So I think this is a good thing that is normalizing. And the same things happen with the 20 to 30 year, right? You can see the price of the 20 to 30 year is coming into corrective territory here. And I think that this is a nominal level that we should creep to the sideways now. Once we get into this range here between the 130s and 120s, this should be the nominal. Okay, now important things this week. The Fed is going to make an interest rate decision, and obviously they're not going to increase the interest rate. They're going to stay the same. If Powell does decide that he's going to increase the interest rate, the market's going to have a meltdown, guaranteed. Okay, or we'll have a deep correction, like a 10% correction kind of thing, if that happens. But it's not going to happen. He said it many times before. This is a very dovish Fed. He has no intention to spook the markets. He's not like previous Fed where they go on an ego power trip. This guy's actually a humble guy. He says it as it is, and he's been really good about what he says. Next, we also have building permits. Core retail sales. This will show us the continued health of the economy this week, and we should watch for these numbers as well on Tuesday. Building permits will show you how the housing market's going. Crude oil inventories. This will be the deliveries at Cushing's. I will be watching this one closely. And then FOMC economic projections. So on Wednesday is the day you want to trade very lightly. Interest rate decision, FOMC statement, FOMC press conference, all happening on this day. You really don't want to be trading. And I can guarantee you that this week's going to be a slow week. It's going to be a very slow week. It's going to be a week where you see light trading on Monday, light trading on Tuesday, light trading on Wednesday, and more than likely on Thursday and Friday you will see a lot of market activity. So Thursday we have initial jobless claims, which will give us a first underpinning of how the job market is doing as well. And the Fed manufacturing index for Philadelphia will also be out on Thursday. So lots of economic news this week that you have to watch for. So keep track of that. That's another thing. Okay, so through all of this, what is the main sector to watch this week? I personally think that we should continue to press the rally in cyclicals. Okay, so cyclicals is going to be the sector that I think we should be trading this week. And when I say cyclicals, what does that mean? Cyclicals means anything that has a business cycle. Your travel stocks, your even your like all these right here. Your it could be also, it could also be TGX and all these, Starbucks, McDonald's. These are pretty cyclical. Nike, cyclical. You also have your Netflix. It's also pretty cyclical. I actually do like Netflix specifically. I think there was some rumors about Netflix. Also, there's a catalyst for that. And then what else? A whole bunch of others, right? Your travel stocks, your Las Vegas stocks, your airlines, cruise lines, semi-conductors are cyclical, banks are cyclical. Okay, we'll see obviously where the risk to reward ratio is better during the live trading sessions, but more than likely these are the things that will continue to rise. And then also the best thing that you can look at will be a combination of cyclical plus reopening, right? So cyclical stocks that are part of the reopening of the economy. So your travel stocks are the best, right? Also the Vegas stocks. The Vegas stocks are actually the ones that you also want to go for. I think that, LVS, MGM, all of these are great ones to trade for now. We may see some buying up of those bullish plays, and those will be pretty good to trade this week specifically. So I don't know if tech will be rotated into just yet. I think that the rally still wants to press on reopening and that stance. this week as well. I do see, I mean, I did obviously see some money going to tech, but we've been pretty much flat this past week. So, and remember that when that happens and if it happens, then the Dow Jones is going to correct downward, right? So I'm already positioned for this. I took some Dow Jones puts as of Friday, and I'll be adding to that position as I go forward. That money that comes out of the Dow Jones, don't forget, there's been a lot of money sitting on the sidelines, guys. All the money that came out of the bond market, remember that these two markets, these yields are going up, that means people are selling bonds here. These prices of the bonds are going down, means people are selling bonds here, right? Where is all this money? All of this money is rushing into equities, okay? And so there's a lot of money sitting on the sidelines. There's trillions of dollars sitting on the sidelines, billions of trillions, waiting to be deployed. And the rally, in my opinion, still hasn't even begun yet. We are barely breaking out of the all-time high on SPY, on Nasdaq, on SPY and Dow Jones, right? And Dow Jones is obviously a little overextended here. Not a bad idea to hedge, but you get the idea. Trust the cyclicals, continue looking at what the opportunities are. And remember that the top weights in these indexes are always going to be the technology stocks that will drive it. And so you should be taking strategic positions in all the big FANG stocks, the ones that are undervalued, okay? The ones that are undervalued, like CRM I just give you a tip off that CRM is trading at an unrealistic price, right? The stock is worth a lot more than what it's trading at. And so it's a good time to buy these stocks. Okay, well, that's good. I think that's all that I want to cover today. Nothing much else apart from that. I appreciate you guys taking your time out to be here on the webinar. So the theme of this week is more than likely going to be, let's see. I think, should we worry about inflation? I think that should be the theme of this video. Should we worry about inflation? And I hope to see you guys on the next webinar next Monday. We do this every every Sunday night to prepare you for the market for next week. And I hope you enjoyed it. So I'm going to stop the recording here and thank you for tuning in.